And Bruce McCain, a fellow Buckeye, coming to us from KeyBank in Cleveland, Ohio. Bruce, is there a reason? A lot of traders walking around this morning saying there was no reason for the 100-point rally that we saw earlier. Ended up only 50 points at the end of the day, but still a big green arrow. Why?
I think in general, most of the economic news that we've seen hasn't been nearly as negative as many people thought. And as we've gone through what looks like a bottoming process and exhaust some of the selling pressure that we've seen, it's just allowed the markets to lift more often than they've dipped back. And while that isn't over, I think as long as the news continues to exceed expectations, the bias is to the upside.
Although, I got to cite Gail Dudak again because I had a great interview with her this morning. She pointed out, look, the first quarter growth, 1.9% at first glance, then 0.4% when we look back and adjust it, 9.1% unemployment. That isn't going to get any lower unless we get 3% or more GDP growth per quarter. I mean, that's rough. That economic situation doesn't sound like it's at all good.
Well, we wouldn't argue that things are good. I think the real issue is, are they going to get a lot worse than they have been? We think that you're online to maybe do 2.5% as kind of a baseline GDP growth, but the numbers we saw in the second quarter were abnormally suppressed by shortages in autos and technology, and as that lifts, it gives us an opportunity to see better growth numbers in the coming weeks, and we think that will lift the market some from where we are now.
Hey, Bruce, I want to bring in Nouriel Roubini, of course, famous economist known for sort of being a doomsayer. Here's what he had to say this morning on Bloomberg Television.
The last few days, the markets are rallying on expectation of the big QE3 done probably September 21st, but I think there's going to be a short-lived rally. And when the macro data, ISM, employment, consumption, housing, are going to come out worse and worse and worse, the market is going to start to correct again.
So, Bruce, everyone's been pointing this out on the big up days we've had this month, which have been a few and far between. But on those big days, we haven't seen a tremendous amount of volume. And on the big down days, we have. So do you fall in line with Nouriel Roubini on the market rally being short-lived?
Well, we wouldn't want to be painted as overt optimists and looking past some of the bad news, but I think that that's overly negative. Again, we think that a lot of this has more to do with surprisingly better economic news than many had feared. The market almost priced in a recession. It doesn't look like that's in the immediate offing. And again, while you certainly are not seeing heavy volume at this point, we thought you would see a much more extended bottoming process with far more retesting of the lows than we've seen. We actually believe that the market action to this point has been encouraging and again does point to the possibility of considerably more rallying before we exhaust the full potential of this market.
So you don't think that we'll continue to test the lows going forward? You think that was it?
Well, I think that there's certainly the potential to go back down and retest the lows. But on the other hand, I don't think that it will be quite as severe as you might normally see, simply because the overall outlook is turning a little more positive than it was even a couple of weeks ago. So from that standpoint, I think it gives us better upside.
So, Bruce, you're a lot more bullish in that case than a lot of the people we talk to. Mark Travis, we spoke to earlier, who goes in and loves this kind of volatility because it helps him pick small cap stocks. He's been very good at that. Do you think it's a good opportunity to pick up big cap stocks as well here?
I think if you choose carefully what you're purchasing, this is an opportunity. At the same time, we're concerned longer term about the slowing growth overseas and the potential for a cataclysm with the credit crisis. So I think you want to avoid losing sight of those sorts of problems that are on the horizon. We just think that in the meantime, you'll have a better chance to become a little bit more neutral in your exposure and not have to sell at fire sale prices if that's what you need to do within a portfolio.
So what do you buy right now if you're cautiously optimistic?
Well, we have been gradually trimming back on some of the more aggressive exposures in basic materials or industrials, consumer discretionary areas, but we've been trying to take out the companies whose are faltering in their basic fundamentals and replacing them with a little bit more exposure in healthcare, for example, or consumer staples or some of the other more neutral sectors to even up our weights without becoming aggressively defensive.
Bruce, I didn't hear you mention utilities, but Adam, I know you've been looking at utilities.
Yeah, I sure have. Well, Bruce, as I'm listening to you talk, I hear a bullish case, I hear a bearish case. I'm not sure exactly which I believe more. Let me just ask you about utilities. You know, the utility ETF, UTY, frankly, or XLU, you know, up about 9.5% year to date. When you add in the dividend, it's up 8% just on plain old raw return. I mean, why not just sit it out in this? Why spend so much time worrying about, is it a bull market, a bear market? Do I buy this? Do I buy? Just go buy some utilities and sit in there and get paid to wait.
Well, I think arguably there is a case for that, but at the same time, when you look at the relative performance, that's shot up because everything has gone down. Unless you're redeploying cash, we think you need to be a little bit patient and not try to sell when the overall market sectors are down to redeploy to the more defensive holdings. So I think it pays to be a little bit patient, but to keep your eye on the longer term and make sure you're a little bit more balanced going into 2012.
Bruce, I want to go back to consumer staples and healthcare. You said that you'd bring them to neutral exposure at this point, but what stocks in particular do you like in those sectors?
We've looked at things like McCain, the drug distributor, in part because they're a little more focused on generic drugs and the fact that they have some specialty exposure with the U.S. Oncology purchase. You know, a variety of names, perhaps something like Smucker's in the food area, where the brand name exposure, even though you've got some commodity price issues with a name like that, the good steady growth and the higher dividend yield will tend to give you a little bit more stable base if the economy begins to slow more severely in 2012.
Bruce, I know you like James Smucker, McCain. What's interesting about both of those picks is that 90%, 91% of their businesses are domestic. Are you making a statement there? Is that just coincidence, or do you want to avoid international exposure?
No, there is some forethought. The biggest weakness we see in terms of aggressive raising of interest rates, and therefore the biggest deterioration in the leading indicators, has been in many of the overseas economies. For that reason, we think this, as the U.S. economy, much like it is most cycles, may be a haven of safety if things turn markedly worse in the global economy. For that reason, having more domestic exposure, in our view, is a good defensive play.
All right. Well, there are a lot of bulls, though, out there on the emerging markets. And Sheila, you've been taking a close look at some of the emerging market stocks.
Yeah, that's right. And because along with the rest of the stocks around the world today, it was certainly a good day for emerging markets, up about 2% on the day. And in fact, we've seen the biggest 4-day gain since May of 2010. You know, when you step back, though, look at emerging markets for the month, you can see they are still getting hit hard. In fact, emerging market stocks down about 9% for the month. That is the worst performance it has clocked in since 2008. Bruce, you've mentioned more than once that you have your eye on the long term. It's important for investors to keep their eye on what's going to happen down the road. I know you've also cut back your exposure on emerging market stocks. You know, we certainly seem to be in a new environment where growth in the developed markets are slowing down. Doesn't it make more sense then to place that long-term bet in those emerging market stocks?
We think that it does, and we do like them from the long-term standpoint. But over the next 12 months or so, given the higher interest rates overseas, we're concerned that they'll slow more than other parts of the world, perhaps, or at least relative to their own growth rates. And because they tend to be high beta plays, because they suffer a lot more in a downturn, a global downturn, we have trimmed our exposure to neutral in that area. We've not gone aggressively underweight, but we are neutral to try to avoid any major downturn.
Bruce, I can't let you go without asking you about QE3. I mean, what do you think of the Fed's position here? Are we likely to see it soon, or something from the Fed?
We don't think that QE3 soon is likely. I think they're looking at the potential for some resurgence of growth in the U.S., and politically it would be much, much more difficult for them at this point. Perhaps some sort of a variation of selling the short-term bonds to move longer term, but I think in general they're going to try to hold back as long as they can, and we do believe that the shorter-term trend in the economy will hopefully bring better news.
All right, Bruce, we've got to leave it there. Do appreciate you joining us here on Street Smart. That was Bruce McCain, Chief Investment Strategist of Key Private Bank.